Hello, everyone, and I'm starting the preparatory series for the International Economics Olympiad 2026 finance track with the review of the questions, multiple choice question in finance from the 2025 track. So let's start with the question number one, crowdfunding. We have a case of a new business venture that needs to be financed via crowdfunding, and we are considering two options to finance it: either with repayment of that is fixed in dollars at 1,700 for 10 years. So that's like a debt contract, right? So repayment a certain amount of money every year, no matter what the conditions are. So that's a debt contract. Or alternatively, the entrepreneur promises to repay 1,700 worth of clothes every year. So provide payment in kind, essentially, in the clothes that the entrepreneur will be producing. So he's not confident in the future demand. And then we are asked what are the options. Okay, so it's either option one is the best, option two is the best. Both options are equally good is a possible answer. And then option D is saying that the option one is better if the interest rates are smaller than 10%, and option two is better if the interest rates are higher than 10%. Okay, so first of all, let's look at the correct answer, and then we'll get into a bit of more of a detail of what this question is asking. So the correct answer, as you probably seen in the publication, is that if as stated in the question, that the demand is certain, offering clothes, so in-kind repayment is better because that risk shifts the risk to contributors. So the entrepreneur is not bearing the risk of high or low demand, so volatility in the demand in the coming 10 years. Rather, she's essentially guaranteeing herself demand for that much worth of clothes every year because contributors are willing to accept those clothes as a repayment for the funding at the original period. So that means that the shift in the risk is to the contributors, and our entrepreneur avoids the risk of not meeting debt repayments in case of poor sales. Okay, so the way the question was formulated, the answer was very clearly option two. Now, what could be different? So what are the things kind of left outside of the current discussion, but could come up with a similar question? So first things first, let's think about risk. How do we account for risk when we make decisions? So typically we say that the fundamental question of finance is looking at the fair value of an asset. Any asset can be represented as a claim on cash flows. For example, if you're talking about a share, owning a share means a claim on dividends. Okay, if you're thinking about corporate bond, owning a corporate bond means owning coupon payments and repayment at maturity. Okay, so whenever we think about owning an asset, owning a claim of cash flows, when we think about valuing them, we think about correcting for two things: the time value of money and the risk in those cash flow payments. So the further the payments out, the smaller would be the current value of that asset. So we don't like waiting. Alternative use of funds means that the further the payment is out, the lower would be the value. And the second thing we don't like, quote unquote, is risk. So typically the marginal investor we think is risk averse, meaning that the marginal investor prefers safe payments over risky payments. So it's a flipping a coin for 0 or 1,000. The marginal investor prefers guaranteed 500. Okay. Now, what it means is that the discount rate that we use in discounting the cash flows is typically compensating us for two things: the time value of money, which is typically measured by the risk-free rate, plus some compensation for risk compensation. There are different models that model how exactly we should be compensated for risk, and so on and so forth. So the fact that the option number D brings up the question is that maybe the correct answer to this question depends on the amount of the interest rate. It's hinting in that direction. So in principle, the more uncertain our investor feels about kind of realized demand in the future, the less kind of the less is the value, the less is the present value of this future kind of future payments to her as of today. Okay, so that's the general intuition that you should be aware of in this case. So the more risk that she anticipates, and especially if that risk, the more this risk is sort of business cycle risk, the more it moves with the business cycle, the lower would be the present value of that kind of stream of cash flows, value of her business as of today. Okay. Now, what else is left outside of this discussion at the moment? The way the question is framed, we say that the value of the cloth is 1,700. Typically, the way we in business, there are two ways of valuing a good. When it's sold, we say that it's valued at the price that the consumers pay. And when we count it in our inventory, or when we say how much does this good is worth to produce, we look at what is called cost of goods sold or cost of sales, depends on the accounting system that you're looking at. But essentially, this measures how much does the business spend to produce this item. And typically that is labor that goes in there, cost of inputs, like physical inputs that you have to put in there, and so on, so on and so forth. So one way, if the question would have specified that, say, 1,700 was cost of goods sold, then the question wouldn't have been so obvious, because there would be a distinction of, say, like, okay, so in 10 years, maybe the inflation will go up and the price inflation would accumulate and the prices would go up. And so what does it mean in terms of saying like 1,700 in terms of the value of cost of goods sold? So maybe if the demand is strong, then the entrepreneur might prefer to actually sell the goods at 1,700, and then the actual revenue that she might generate with that might be, 2,000, 5,000, depends on, again, how much of a markup she as an entrepreneur can charge, and then maybe that would have been a better option. So all those things are not kind of explicitly specified in the question. On the opposite, all of these lines of thought are ruled out by saying that she is uncertain about the demand, and that's her main priority to worry about. Okay. So that's why the option number 2 is a very clear one. But if she was sure about the demand, if she anticipated that she could increase the markups, then we would probably lean towards option 1, because that would allow her to kind of fix the payments in dollars. If anticipated inflation is high, then selling the goods at COGS of 1,700 would probably mean ability to earn higher markups, and that would be repaying that investment, repaying that crowdfunding in dollars would be actually a better option for her. But again, in this question, very clear that the optimal thing to do for this entrepreneur is to repay in kind. She's uncertain, and we are not explicitly said that 1,700 is COGS. We are not explicitly said that she's losing any markups that she could have. Or is it COGS? Is it price? So all of those things outside, very clear that the best option is number 2. Okay, so let me know if you have any questions still left unclear about this question. Is there anything that you would like to clarify? Happy to hear from you. Hope to post an update soon.